Hi, this is Alan Olsen, Managing Partner of Greenstein, Rogoff, Olsen and Company. Our firm has been established in the heart of Silicon Valley for the past 50 years. Today I want to talk about Section 1202, Small Business Stock. This is a section of the tax code that will allow a permanent exclusion of gain if you are a founder or an early employee of a company, where you can establish up to $10 million of your gain upon disposition of the stock. Let's talk about more. So to encourage investment in new ventures and small businesses and specialized business investment companies, Section 1202 of the Internal Revenue Code grants relief to investors who risk funds in these businesses. Non-corporate investors may exclude the 50% of the gain they realize on the disposition of qualified small business stock issued after August 10th of 1993 if they hold that stock for more than 5 years. As part of recent legislative efforts to stimulate the economy, Section 1202 exclusion was raised from 50% to 75% for qualified small business stock acquired during most of 2009 and 2010. Then, in September of 2010, the Small Business Jobs Act of 2010 was enacted, further amending Section 1202 to exclude 100% of qualifying gain from gross income. For qualified small business stock purchased between September 27, 2010 and December 31, 2010, a 0% effective income tax rate will apply at least to the first $10 million of gain upon its ultimate sale if applicable requirements are met. Excluded gain from these investments will not be treated as a preference item for AMT purposes, so the benefits extended equally to all the AMT taxpayers. The amount of gain eligible for the exclusion is subject to user limits. The exclusion is available to taxpayers who own eligible stock in a qualified corporation and hold that stock more than 5 years. For a gain on its stock to qualify for exclusion, the corporation must be a C corporation other than a DISC, a regulated investment company, a real estate investment trust, a real estate mortgage conduit, a financial asset securitization investment trust, a cooperative, or a corporation electing the Puerto Rico and possessions tax credit. There is also a user limitation. There is a cumulative limit on the gain from a single user that a taxpayer may exclude. Eligible gain from any one corporate issue in a given tax year is taken into account only to the extent that it does not exceed the greater of, number one, $10 million reduced by the aggregate amount of eligible gain taken into account by the taxpayer in prior years from the same issuer, or 2, 10 times the adjusted basis of all qualified stock of the issuer that the taxpayers dispose of during the tax year. Additions to basis are disregarded. The limitation can severely restrict the tax benefit of this provision in the event of a truly substantial windfall. If you feel that you may qualify for Section 1202, give us a call and let us help you go through the analysis on the best way to take advantage of this section of the tax code. There are also exclusions available under the state of California and most states' tax laws, but these states are different than the federal requirements. So give us a call and let us see how we can help you.